The latest inflation numbers have come in, and I really believe that the stock market is reacting to them the wrong way. There are a few big problems with this data that I don't see the mainstream media talking about at all. Your time is valuable, so let's get right into it, starting with how the numbers were reported by CNBC.
On the headline, expected up 0.2% for our consumer price index July read, unchanged, double goose eggs, 0. If we look at ex-food and energy, up 0.3, also less than the 0.5% anticipated. Now, the year-over-year numbers. Year-over-year headline, up 8.5. This is the one I was a bit nervous about. 8.5 brings us back to levels we haven't seen since just April of this year. And finally, ex-food and energy on the year-over-year outlook, up 5.9, expected to be up 6.1. It equals our last look, which was up 5.9, and it underscores the Fed, by its very nature of ill forecasting success, is reactionary. The market's not, and the market continues to do what it's now done for weeks and weeks, and that is long rates are moving down. It believes that transient ultimately will be the correct word. The problem was the time frame. Melissa Lee, back to you.
If none of that made any sense to you, don't worry about it. I'll go through the numbers with you step by step, and I'll explain each problem. There are two reasons that I showed you that clip. First, look at the crazy excitement that CNBC is trying to drum up when they report these numbers. It's almost like we're listening to the final plays in the Super Bowl instead of economic data. Or if you're outside the US, pretend I just said the World Cup. Football is weird. The second reason is what got said right at the end. Did you catch it?
That transient ultimately will be the correct word. The problem was the time frame.
The market believes that transient is ultimately the right word, and the problem was the time frame. So let's look at the numbers, and I'll show you why the problem is not the time frame, but the actual numbers that the Fed uses to make decisions about interest rates. Here's a chart showing the inflation numbers for July, courtesy of the New York Times. Specifically, this is the year-over-year change in the Consumer Price Index, or CPI. The top-line inflation number was 8.5%, or 5.9% if you exclude food and energy. Even better, the price index didn't move at all month over month, meaning prices didn't rise from June to July.
Unchanged, double goose eggs, 0.
Unchanged, double goose eggs, 0. All of these numbers were lower than expected, so everything's totally great and peak inflation is now behind us, right? Well, not exactly. These numbers are averages of averages. Fuel, airfare, and used cars went down in price, but housing and food went up. I don't know about you, but I pay for food and shelter a lot more often than I pay for airfare and used cars. Let's dig into the data, and I'll show you the specific problems that I have with these averages. Here's the month-over-month price changes for July. Let's start with food. Cereal and bakery products are up 2%, as are non-alcoholic beverages. Dairy products are up 1.7%, food away from home is up 0.7%, meat is up 0.6%, and fruits and veggies are up 0.4%. So on average, food still went up in price about 1% month over month. If you annualize that, food at home is still getting more expensive by about 13% year over year, and food away from home is still up about 7.5% year over year. The second problem is rent and shelter. Rents came in 0.7% more expensive, and homes came in 0.6% more expensive. But rent and shelter are slow, lagging numbers. Housing transactions take a long time to close, and landlords often raise rents when leases are up for renewal. The actual national average for rent is up 12.4% year over year, or about 1% month over month, which is way higher than the 0.7% being reported. The median home is 13.7% more expensive than it was a year ago, and close to 30% more expensive than it was 2 years ago. Also, home prices should be pretty volatile in the near future as these overinflated prices start coming down thanks to mortgage rate increases lowering demand. So this average of 0.6% for homes might look good on paper, but it's not a reliable number when some prices are up 5% and others are down 5%, just as an example. The third problem is in energy. Take a look at these amazing numbers. Piped gas is down almost 4%, gasoline is down 7.7%, and fuel oil is down 11%. That's pretty amazing, right? Well, the problem here is that historically, gas, gasoline, and fuel are all incredibly volatile assets. No pun intended. I obviously hope that gas prices keep making new lows, but we could see these numbers come in higher than expected next month, just like they were lower than expected this month. Alright, so why am I so focused on these food, shelter, and energy prices? It's because of the PCE, or the Personal Consumption Expenditures. The PCE number is the number that the Federal Reserve tries to keep under 2%, not the CPI, which is the Consumer Price Index. What's the difference between the PCE number the Fed is looking at and the CPI number that CNBC is reporting like it's the finals in football? PCE inflation places a lower weight on, you guessed it, food, residential rents, and fuel. The three numbers I just showed you are either still going up or are being reported as lower than their true values. Now, let me clarify something here. Historically, the PCE and the CPI have usually been within about 0.5% of each other, but the gap between them is now at an all-time high of 2%, meaning the PCE is about 2% lower than the CPI today, and this difference can keep slowly going up over time. This means two things. First, it means that if the Fed reached their goal of 2% PCE inflation today, we consumers would still actually be feeling 4% inflation as measured by the CPI, which is well above the historical average. In that case, inflation wouldn't be transient at all. We would still be feeling that increase at gas pumps and grocery stores while the Fed pats itself on the back. Remember, everything is still up month over month except gas and airline tickets. This is the problem with taking averages, especially when you're dealing with volatile numbers. The other option is that the Fed keeps aggressively fighting inflation to bring CPI back in line with its 2% goals. Specifically, they would keep removing money from the supply and raising the overnight lending rate until spending demand drops. Then, the inflation in prices of goods and shelter would slow, and this PCE measure would fall back in line with the CPI that the market is tracking. If they go that route, then they'll have to raise interest rates much higher than the market is currently expecting, because just like CNBC reported, the market thinks inflation is starting to crack when it's really not. These surprising rises in interest rates would be bad for the markets in the short term, especially for growth stocks. So what we should be really watching right now is how big this gap between personal consumption expenditures and the consumer price index will get. The bigger it gets, the more likely inflation will be here to stay, even if the Fed gets this PCE number under control. That's long-term bad. The smaller this gap gets, the better, but only if it shrinks without the Fed having to ramp up their interest rate increases even more. Otherwise, that's short-term bad. So, what am I personally doing with all of this information? I'm still keeping cash on the side. I know this latest market rally looks tempting, but we may be in for some big surprises when the Federal Reserve meets next, which is at the end of September. I'm also looking for stocks that are overreacting to all of this news to take advantage when the market gets too greedy or too fearful. Want to know which companies I'm watching the most? Check out this episode next. And if you feel I've earned it, hit those like and subscribe buttons to let me know that you find this content valuable. Make sure to share it with someone you think could benefit from it as well. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.